Manish Sonthalia is with us, Chief Investment Officer at Emkay Investment Managers. Manish, good to have you with us here. Thank you for your time. You know, fag into the year, and I think we are just about getting into that period where we start to talk about what 25 will look like. But before we get there, just your sense. Does it look like? Is it beginning to look like that we are putting this corrective phase behind us? The first 10% plus kind of fall for the indices over the last 3-4 years. Do you think we are starting to put that behind us now?
So, Prashant, of course, we have seen a 10% correction on the back of massive liquidation by FIIs. Now, the crux to whether the markets would have seen the bottom or not would really depend on how earnings shape up. You know that earnings have been very anemic, single-digit sort of earnings growth for FY25. And because of very slow government spending, you are also looking at a very muted earnings growth for FY26. At best, I mean, as things stand today, and things could change very fast because there could be a lot of government spending which could be due in second half of fiscal 25, or there could be some measures to revive demand in the system. Consumption is really falling off the cliff. But as things stand today, we are looking at a 10 to 12% sort of a growth in Nifty 50 earnings for FY26. And if you would like to extrapolate that sort of a growth for even FY27, you're looking at another 10 to 12%. So average of FY26 and 27 comes to around 1250 or 1245. Now, for a 10 to 12% earnings growth, the moot point is whether you would be willing to assign a 20p multiple, which the markets have given over the last 3 to 5 years. Whereas the 12-year long period average of Nifty 50 has been 80. So if you would want to see the maximum margin of safety, I can believe that the markets can test. I'm not saying it will test. It will depend on a lot of things as to how earnings shape up and how expenditure happens and how demand revives on the consumption side. But it can come down to 22,000, 22,500. Markets don't fall in a straight line. And whether the FIs would have seen the worst of selling or there could be more, because emerging markets as a whole are selling. So it's not only particular to India. These things would be there. And I think it's a pullback. But it's good to see green on the screen after a long time. But one would really keep fingers crossed to see if the market sustains that kind.
Okay, so that takes a big, bold person to give out a clear call. I mean, even if it's bearish on a morning like this. Manish, great to have you on. I just heard you say that 22,000 is still on the table, yeah?
Now, fundamentally speaking, should be 1175 on a 1050 base for FY25. That is a 12% growth. And if you were to extrapolate another 12% on 1175, that gives you 1350. So 1 year out, an average of 1175 and 1315 is 1245. Now, the moot point is for a 12% earnings growth on Nifty 50, would the market be willing to give a 20p? Whereas the long period average of 10 to 12 years is 18 times. So the maximum margin of safety would happen if you were to extrapolate 1245 and multiply it by 18 times. That would be broadly 22.5.
Manish, the numbers are perfect. We completely get the logic going by numbers. But the thing is, it's the direction of money which starts becoming illogical at times, right? And it's the FPI exodus, which is why we got the correction. And who knows what they're going to do tomorrow. If they start returning, then what multiples do we trade at? That's a different debate. Right now, I want to focus on what we're seeing at present, which is, an interest coming back in the PSU side of the market. Obviously coming in, emanating from what we saw over the weekend, this massive victory for the NDA. But again here, rationally and logically speaking, would you advise a re-entry in PSU stocks?
So I have always believed that PSU stocks have great value. Now, the incremental news flows is that the government in the second half of fiscal 25 would be signing or has already signed some 16 lakh crores worth of projects, and they would all come through the PSU, the government-owned company. So that is one news flow. And obviously, the entire revival in earnings for FY25 is built on the fact that government opens its purse strings, which was very, muted, so to speak, in the first half of fiscal 25. So that's the big news and big call on the PSUs per se. There is deep value, and obviously the DPAM new diktat paying 30% of profits as dividend, etc., all very good. And there is bound to be re-rating in the PSUs, not only in the banking space, but I think all monopolistic PSUs would have a case to be bought into. As far as the FI flows are concerned, look, I mean, there's nothing to believe that their selling could abate even now, because they have been selling across emerging markets. It's not one market preference over the other. It is basically money going to the US, and thanks to the change in regime in the US, you would see that massive outflows are happening from across emerging markets. It was so surprising to see Friday you had a net negative figure from the FIs, in spite of very strong pullback and a short covering. So, yes, there is a bout of short covering, and markets don't correct in a one way, on the downside. But I think it's time to be very cautious. Low-hanging fruits of the last 4 years, when anything bought on a dip, you made money. I think that era is over. It is time to pick and choose very carefully.
So money making will be a little bit more difficult. Manish got that point, and you're sounding a little bit cautious. Still now, we have been talking about just the earnings downward revision. You're talking about the multiple as well could be not as high as it was earlier on the Nifty. People are giving it 22, 23 times. Or you said a more realistic number could be high teens. Got that point. The government spending was very, very bleak in the first 5 months of this fiscal. However, in the last couple of months, that's picked up as well. And hopefully that's what supports, a bit of a booster shot in terms of growth, in terms of earnings as well for the second half of the year. Given that sort of a backdrop, would you look at some of these infra themes, to play? Because some of them have corrected a decent amount from the peak.
Yeah, so basically, the disappointing part is that the private sector is not doing the capex. The heavy lifting in terms of spending has to come from the government. And from that point of view, I think infrastructure companies, etc., which have corrected 25, 30% could be looked into. But mind you, again out here, when you take a call on, let's say, capital goods or infra players, and when you want to give earnings multiple to order books which have to be executed over the next 5, 8 years, I mean, I don't think, that sort of a direct correlation exists between an order book, and that to long-dated order books, and PE multiple. I mean, to my mind, that's quite fallacious and driven more by sentiments rather than anything else. At best, you could, let's say, price in earnings growth on order books, which you have a visibility of the next 2, 3, 4 years. But nothing like an 8, 10-year order book, and you want to give a multiple to that. So again, out here, I would believe that the best sectors to invest in current times, given that there is a propensity for the currency to depreciate even from these levels, would be the export-oriented sectors, the IT pharmas of the world. Banking, in any case, was very cheap. You could look in at PSUs and some of the platform companies, particularly the catering to the financial services side of things. I think those would be the best place. Still wary of the capital goods, power, infra, because they could be more sentimentally driven. But having said that, if you have hardcore numbers come through in terms of government spending, then obviously there could be a change in sentiments towards that. But I think valuations mostly are still quite prohibitive on the defense, PSC, railways, infra, capital goods, so to speak.
So valuations are still prohibitive on defense and many of these government-led infrastructure names. So you wouldn't look at buying now unless there's a major pickup in government spending in the second half, right? Just clarifying.
Exactly.
Okay, got it.
That's true.
Okay, Manish, as we come to the fag end of the conversation, leave us with a few names though, bottom-up ideas where you think there is still growth with full disclosure and everything.
Prashant, I can't talk specific names, but suffice it to say, if you look at Q2 numbers, one of the areas where I think there could be a structural re-rating is this whole financialization of savings team, anything to do with tilt towards the equity market. Exchanges, depositories, wealth management platforms, online broking, distributors, there you could see a significant structural re-rating going to the next 2, 3, 4 years. You may find the near-term valuations expensive, but suffice it to say, the growth outlook on many of these platform companies catering to the capital markets, and because they are duopolies, oligopolies, you could have a strong structural re-rating on this whole thing, given that earnings visibility is quite sharp out here. this would be one of the preferred sectors where maybe the entire market is not looking into. And the other sectors where I think there could be a significant outperformance, and we are talking all relative numbers out here, could be your pharma, CDMO, your IT services coming out of a low cycle, and spending is likely to pick up given that the US regime
Right.
change would mean corporate tax cuts and more spending on technology. Those would be helpful for the IT services and obviously banking.
Got
These would be the preferred areas.
All right. Manish, the first part that you said, right, capital market plays, I think we have the CAMS management joining us now. So I think if the management is hearing us, I'd be very pleased to hear that, your views on the subject. So capital market plays and CAMS, of course, is right up there. Manish, thank you very much for joining us. Great conversation as always. Thank you indeed. So